that relates to how you should plan your EMIs every month, considering that home loan rates are going to go up. And if you're planning to take another loan, then how should you plan it? Joining me to talk about the current context and the way forward is Adhil Shetty, the CEO and co-founder of bankbazaar.com. Adhil, good evening and thanks so much for taking the time. Let's start with the context first. Just at the end of last week, you had the policy rates go up by a further 50 basis points. This is a sharp hike, but I think it went along with a lot of people what they were expecting, right? And first of all, give us a sense of where you see policy rates going. Do you see another hike in the offing? And what does this mean on the face of it for borrowers?
Thanks, Alex. Great question. So to answer the first question, the repo rate now stands at about 5.4%. And typically we see new home loans being offered at about a 2.5% additional cost. So if the repo rate is 5.4, new home loans are going to get repriced at around 7.98%. The market does believe, most analysts do believe, that this is not the end of the repo rate increase cycle. You know this better than me, but given that inflation is still above 7%, we're projecting that Q3 also is going to be above the comfort band of 6%. Most of the analysts believe that the repo rate is going to settle at least 0.5% higher, and this is going to end somewhere at around 6%. Now, what does this mean for an existing home loan borrower? So what this means, right, is essentially when the repo rate goes up, your home loan gets reset if it's a repo linked loan, which is what all recent home loans have been. And interestingly, right, in order to prevent a blip in your EMIs, what the bank typically does is they keep your EMI steady, but they increase the tenor of your loan. So the extra interest rate is paid back as a higher tenor while keeping the EMI steady. Now, let me put this in an example. When we started April 1st, right, I had a home loan which was priced at 7%. Basis the repo rate increase, right, of 1.4%, automatically at the next reset date, I'm going to be paying 8.4%. Now, what that means, right, is my EMI tenure, assuming it doesn't get blocked by my retirement age, is going to go up by 94 months. Now, that's a long time of extra EMIs, which is resulting from this 1.4% repo rate hike. I hope that gave you a fair idea of what's happened.
Certainly. In fact, you shared a data point with us, 50 lakh loan outstanding of 20 years. At the start of the year, you had interest rates that were 140 basis points lower than, or rather the policy rate was 140 basis points lower. So effectively, over the past few months, we have gone back to pre-pandemic levels, and that's going to dramatically increase the cost in terms of interest rates. But it's not a uniform increase, wouldn't you agree? In that, the implications for somebody who is in the first half of their home loan repayment is going to be very different from somebody who's nearly completed repaying their loan, right?
Yeah, that insight is a valid insight. You get more deeply impacted by these rate changes the earlier you are in the payment of your loan. So it's true, right? So the example we've given is for someone who's in the first year of a 20-year loan. As you get towards the tail end of your loan, the impact would be less, but then you have to run these calculations online using an EMI calculator.
Very true. I want to talk a little bit more about prepaying the loan, because this is something that a lot of people consider doing, Adhil. And it really is a good practice to get rid of debt as quickly as you possibly can. You've mentioned that in the first hike, which was the increase from 7% to 7.4% in our example, the 40 basis point hike, that you would have to have a certain amount that you prepaid. How do you explain the amount that you would have to prepay for there to be zero impact of an increase in interest rate?
Yeah, great question, Alex. In fact, this is the number one question we're getting at Bank Bazaar right now, saying, what do I do, right? Because my tenor has gone up by 90 months, 94 months. What do I do? So the key insight you mentioned, right, is that prepayment is the way to start pulling back the EMI tenor. So every time the repo rate goes up, typically your EMI tenor goes up, and you pull it back by making a prepayment. Now, I'll give you a couple of examples to make this easy, right? So example number one is, let's assume that you have money available with you. The two repo rate hikes which first happened, right, they hit us at the same time because the repo rate loans typically have a quarterly reset date. So what happened with me, right, is April 1st, I started at 7%. But by the time July 1st came over, both got combined because my reset date was July 1st. So I came in at 8.4%. Now we said if I am in the first year of a 20-year home loan, make a 9 EMI bullet payment, and the additional tenors will disappear. So you will come to status quo ante, and it took 9 EMIs to prepay. Now the second example, right, is let's assume 7% is now. Let's assume. Sorry, the previous example was 7 to 7.9, which was the first two rate hikes. Now we're at 8.4. The calculation now is 13 EMIs. So if I make a 13 EMI bullet payment, then this 1.4% gets neutralized in terms of no additional EMI. But then the counter to this is obvious, right? So the counter to this is obvious is forget 13 EMIs. I don't have even 5 EMIs sitting ready to pay off or prepay my home loan. What do I do in that case? So then we can provide you illustrative examples of what someone typically can do, right? And I'll again give you two examples just to show the power of prepayment. So the first example, right, is example is you pay one additional EMI every year on a 20-year loan. Simple example. Every year you get a bonus, pay one additional EMI. A 20-year loan becomes a 17-year loan. So that's the power of the additional EMI per year. A second example we use at Bank Bazaar is prepay 5% of your outstanding principal every year. So 5% of your outstanding principal every year on a 20-year loan. Your 20-year loan actually becomes a 12-year loan because the prepayment reduces the tenure. So these are some of the pro tips that I can offer, Alex.
Fantastic. I think that goes very well. And to illustrate the point further, the point that you were making on increasing your EMI versus increasing the tenor, in the example that you have provided, it actually stipulates very clearly that the amount of interest that you pay if you increase the tenor is very, very substantial if you compare it with the EMI. So, and the difference in the EMI is actually not very substantial, even though you take an increase of 140 basis points. The difference is as much as 4,300 rupees, which you can actually stomach if you're talking about a payment of 43,000. So this is always preferable, right, Adhil?
Yeah, absolutely, right? So we say that if you can keep your tenor same and pay a higher EMI, your interest outflow will be substantially lower than when you increase the tenor and keep your EMI steady. So if you have a choice, right, try and pay an additional EMI. So one of the pro tips is when you refinance, typically, right, you get a lower EMI because that's what drives a refinance, right? But we advise people to do what we call a switch hit, which is refinance at a lower rate, but continue paying the same EMI because that will really and drastically reduce your total interest outflow.
Mathematical calculation that you must do when you decide to take that refinance option as well, right? Because Adhil, there are charges associated with a refinance option, and that's something that you have to calculate as a percentage of whatever is left and see if it actually makes a difference, right?
Yeah. So the benefit of a refinance is obviously you save in EMI. So that's a straightforward calculation. There are two costs to consider when you refinance, right? So you need to make sure that the saving makes up for these costs. So if you're refinancing with your own bank, there's a processing fee. And a processing fee typically is a nominal amount. When you refinance with a new bank, right, there is a processing fee and there is a stamp duty charges to register that mortgage, which runs into several tens of thousands of rupees. So what we tell people, right, is just go online, do a quick calculation at a bank site or at a site like Bank Bazaar, see what your saving is, but then compare it with the cost of the refinance, which is the processing fee, and the MODT charges, which is the registration charges of the mortgage.
Here's the other point that I wanted to ask, and before we go into the fixed income side of things, is we're at 8.4, or we will soon be at 8.4% in our example, in our home loan example. Personal loans are priced much higher. Are we reaching a stage in the interest rate cycle where it's becoming much less lucrative to take a loan, and if possible, we should try and reduce the amount of loan that we take, build up a corpus that you can use towards, say, putting down the down payment. Instead of paying a 20% down payment, you now try and do half if you possibly can. Maybe put off your purchase of a house for just a bit so that you reduce the implication of that interest cost.
Right. So several interesting questions there. I'll quickly try and answer them one by one, right? So most people today are paying loans in that 8.3, 8.4, but the lowest rate you'll find advertised in the market is in that 8% range post the last change. And the reason that happens, right, to get the lowest rate, you have to be, below 30 lakh ticket size. Your credit score has to be above 800. You should have a woman borrower. So even though we say that the lowest rate is probably at 7.9% today, most people like you and me are paying loans at 8.3, 8.4. So yes, currently we're at 8.4. Also, we're expecting this to increase, right? So we're expecting the lowest rate today of 8% to go up by 50 basis points as and when the repo rate goes up later through the year. Now, coming to your question about should you take a loan, should you purchase, put off your home loan purchase? See, we've seen a lot of changes in the last 2 years, Alex. So when we were chatting pre-COVID, right, we didn't know that rates would go down so dramatically. When I spoke to you 6 months ago, we were rejoicing, right? We were rejoicing that the lowest loan rates were at 6.5%, the lowest they've been in 15 years. But keep in mind, right, the person who took the loan at that time is now paying 1.5% more. So the rate cycle will go up and down. Typically, a cycle takes, like we've seen with what happened in COVID, 2 to 3 years. So my view, right, is don't postpone a home loan purchase, because whether you come in now or you come in later, you're typically coming in on a floating rate loan. So just because it's low today, right, which is what it was 2 years ago, today it's gone up, and this high won't last forever. As soon as inflation comes under control, we expect that the repo rate will start to go down, right, to spur growth. So I'd say you can't time it. If you find a great property, it's an emotional buy. It's something that everyone wants to own their own home, build, a beautiful home with your family. If you find something good, you're getting the right price, feel free to go ahead with it. Now, coming to your last question, right? Is it better to have money saved for the down payment? Or let me tell you the question in a more practical way. Should you be saving for your holiday travel and not borrowing? I'd say the answer is absolutely yes. What you can save, right, definitely cuts your interest outflow. You're not paying any interest to anyone on it. If you can save for the down payment, if you can save, for that refurbishment or upgrade of the house, by all means, right? If you can make a down payment, always make a down payment, because that reduces the interest outflow on your account.
Okay, let's talk about the fixed income side of things, right? We have a situation where 140 basis points will eventually get passed on. The latest increase, of course, will be passed on the fixed deposit side. We are possibly, like you said, looking at a potential increase of 25 to 50 basis points, and possibly sooner rather than later. Does it make sense to get into slightly longer term fixed deposits? I know a lot of people were sticking to the shorter end of the spectrum because they were expecting interest rates to go up.
Yeah, so great question, right? So let me just cover a few of the basics here, and then we can see where this goes. So the first thing, right, is Alex, a repo linked home loan automatically goes up on the reset date when the repo resets. But the fixed deposit is not like that. So even though the repo rate went up 0.5%, we have to wait for the banks to start building it into their fixed deposit rates. So let's say the general public FD rates at large banks today is 5.5%. We'll have to wait weeks, if not months, right, for that 5.5% to go up to a 6%. So the general advice we give to people is twofold. So one, don't lock in for a long term now, because you know that 30 days from now, 45 days from now, the fixed deposit rate is going to go up basis the repo rate increase. Furthermore, we expect that there will be further repo rate increases, which will flow into your FD rate. So I agree with the principle that try and ladder. So if you can get a good rate on a 6-month FD, take it. Maybe put some money in a 6 month, some money in a 1 year. As soon as the 6 month matures, then put it in a new FD, because in 6 months the FD rates will definitely be higher basis what everyone expects. Another thing which I was just checking at Bank Bazaar, right, is the liquid fund rates have started to go up. So now 3-month trailing liquid fund rates, which used to be very low, right, have started hitting that 4.6, 4.7% number, and very soon are expected to be north of 5%. Now, the advantage of a liquid mutual fund, right, is interest on FD is typically at that 30% level. So you think you're making 6%, but actually post-tax you're making 4%. The advantage with a debt liquid mutual fund, right, which is what a liquid mutual fund is, if you hold it for 3 years, you get long-term capital gains, which benchmark, ballpark is about 10%. So you might actually be better off as liquid FD rates, liquid mutual fund rates go up because of the tax saving in terms of using it. One other thing I want to call out, right, is senior citizen FD rates are very special. These rates, I think, as they go up, make sense to lock in, because liquid mutual funds don't give anything special for senior citizens. But fixed deposits, right, have special offers for senior citizens which are higher. And if you can lock in a 7%, 7.5% senior citizen FD rate, right, with a good bank, you might be in a good fixed income situation.
Especially considering that a lot of people depend on that interest income, and cumulatively they don't have a large amount of interest income then coming in, since they don't have that regular source of income. Adhil, thank you so much for joining in. We've had a comprehensive conversation.
Thank you, Alex.